In this video, you'll find out all you need to know about bonds so you can decide if you should invest in them. Good day to you folks. Money Jim here, your money pal. Bonds sure can be complicated. So in this video, you'll find out what bonds are, how they work, how they performed, and why plenty of folks invest in them. And by the end, you'll know if they're right for you. Well, of course they are. Well, look who it is. My old pal from across the pond, it's Modest John. Good day to you, Jim. Pleased to meet you. John sure does love bonds, so there ain't no one better to help us find out all about them. Very kind of you to say, old chap. So John, why don't you start us off by telling the folks watching what bonds are? Certainly. Bonds, alternatively known as fixed interest or fixed income, are a category of investment securities that pay a regular income in the form of coupons to the bearer until maturity. Yeah, thanks for that, John. My pleasure. The easiest way to think about bonds is they're an IOU. They're debt, but it's not a debt you paying. Nope, you providing it. See, when governments or companies want some extra cash to pay for something, they can get it by creating bonds to sell to investors. In return for say $100 for each bond, they'll pay the investor a fixed amount of income for set length of time. And at the end, when the bond reaches what's known as its maturity, you get your $100 back. Sounds pretty good, don't it? Debt in reverse, where you're getting paid interest instead of paying it. Precisely. Now there's a ton of different types of bonds. They can vary by who creates them, how risky they are, how long they run for, and so on. So John, why don't you go tell us some of the main ones? Of course. Firstly, there are government bonds, known as treasuries in America or gilts in Britain. Additionally, there are corporate bonds, of which there are two principal categories, investment grade and high yield. Government bonds are seen as the safest type there is, as they're least likely to default or not pay investors back, whereas corporate bonds got more chance of default. Those high-yield bonds John mentioned are the riskiest of them all, as they got the highest chance of default, and that's why they're also called junk bonds. Now, when the risk is higher, investors want to earn something extra for taking on that risk. When it comes to bonds, that means more income. So in general, government bonds pay the least, corporate bonds pay more, and junk bonds pay the most. Now, bonds can also differ by how long they run for. John, want to step in here? Certainly. Short-term bonds typically have between 1 and 4 years until they mature. Intermediate or medium term between 4 and 10, and finally, long-term bonds reach maturity after more than 10 years, even as far as 30 years or more. Because you're putting away your money for longer with longer-term bonds, most times you earn more income too. That's because there's another risk: inflation. Dreadful thing, ghastly. See, inflation makes your money worth less over time. Because most bonds pay you a fixed amount, inflation's going to make that amount worth less the longer time goes on. And it'll make your original investment worth less when you get it back too. So to make up for all that, the longer term the bond, the higher the income is in most cases. Not forgetting inflation-linked bonds, dear chap. Good point, John. See, inflation-linked bonds, or TIPS as they call, or index-linked gilts in the United Kingdom. Yep, those two, they go up in line with inflation. So the amount you get paid and what you get back at the end increases over time. Splendid, just splendid. So why don't every bond investor just invest in those, you might wonder? Well, it's because their income is lower. And if inflation ain't as much as folks thought it would be, you would have been better off with standard bonds. Of course, if inflation ends up being more than expected, TIPS investors did the right thing. Okay, that's enough about the different types of bonds. Let's find out how they work. John, can you take it from here? Jolly good. Bonds don't just provide income, they also provide the opportunity for capital appreciation. With their inverse relationship to interest rates, bonds typically rise when interest rates fall, and conversely, usually fall when interest rates rise. So even though bonds seem as generally a safer type of investment, that don't mean things can't go wrong. Not only you got the risk of default and inflation, you also got interest rate risk. So if the Federal Reserve, or the Bank of England, and all them other central banks start putting up interest rates, bonds could be in trouble. That happened in recent years when interest rates started going up to try to keep a lid on rising inflation. And imagine what happened during the 80s when interest rates were hitting 15, 16%. Those are indeed dark times. But of course, it works the other way too. So when the interest rates get cut, it's usually happy days for bonds. Marvelous! Does that mean you should just invest in bonds when interest rates are getting cut and sell them when rates are going up though? What an absolutely preposterous idea. Bonds, like all investments, best held for the long term as part of a well-balanced, diversified portfolio. You said it, John. If you're going to invest in bonds, don't try to be smarter than the market and jump in and out. Stay committed for the long run. Trying to time the markets, whether that's bonds, stocks, or any other type of investment, is real darn hard, and there's a chance you get it wrong and end up worse off. So how bonds done over the long term? Modestly, just the way I like it. You can say that again, John. See, over the last 5 years, in general, bonds ain't gained at all. In fact, they've lost money, while the global stock market nearly doubled. Yes, well, what about the longer term? 5 years is rather short. You're right there. So let's look at 10 years. Still ain't great. Bonds average about 1% a year, while stocks average about 10%. Keep going, same story over 15 years. And over 20? Well, now it's better, because bonds average about 2.5%. Splendid, which is about the average rate of inflation. So in real terms, you didn't make hardly nothing at all over 20 years in bonds, while global stocks went up nearly 400%. So why on earth would anyone want to invest in bonds? Because those ghastly stocks you Americans always talk about are too volatile. You hit the nail on the head, John. I beg your pardon? Look here, during 2000 to 2002, ouch, the bonds gave you decent enough gains. The same thing in 2008, when the stock market fell even further, over 50% at one point. But bonds again gave you a positive return. And there's plenty more examples. Nearly every time stocks had a big drop, bonds did much better. But notice I said nearly, because it ain't no guarantee. Look here in 2022, stocks and bonds went down together. Interest rates went up and up and up, sending bonds down and down and down. Now, that's pretty darn rare. In fact, something like that's only happened a couple of times in the last 100 years. Point is, there ain't no guarantees. More often than not, bonds provided some protection when stocks dropped. And therefore, the prudent investor always holds bonds in one's portfolio. If you look at most so-called balanced portfolios, you'll almost always find bonds in them. The less growth focused, the more cautious the portfolio, the more bonds will be in there. You'll find plenty in mine, no doubt, John. Go look at any target date retirement fund. There's plenty of them. Vanguard, BlackRock, Fidelity, they all offer them. And you'll see the closer the fund gets to the retirement date, the less they'll have in stocks and the more they'll have in bonds, which makes them an excellent choice for those who want investment risk managed on their behalf. Right on. But that don't mean bonds are right for everyone. If you're still a long way from your retirement, you focus on growing your investments a ton. Having a big chunk of bonds in your portfolio, or any at all, might not be right for you, because they could hold back your gains in the long run. Now, no one on YouTube or TikTok or anyone else online, and that includes Jim here, can and say what's the right amount of bonds for you. If you're unsure, you probably want to go get financial advice from a registered professional. Quite so. But what I can say is bonds tend to be for folks who already got most of the growth they need from their investments, like John over here. And are more focused on keeping everything nice and steady and getting a regular, reliable income. Couldn't have put it better myself, old chap. Well, it's been a pleasure as always, Jim. I must dash. I'm having tea with His Majesty. Well, say hi from me. So there you have it. All you need to know about bonds. Whether they're right for you or not depends on where you are in your investment journey. See you next time, sunshine.